Good morning, ladies and gentlemen. We would like to thank you for attending this conference call on our BL Global Flexible Euro Fund. During the presentation, our Chief Investment Officer, Guy Wagner, will give you an overview of his vision of the financial markets, which underpins the investment strategy he implements in the portfolio, the positioning of which he will also detail. Since the beginning of this year, in a particularly complicated environment, this flexible allocation strategy has generated a net performance of 0.7%, against a decline of -3.6% for its Lipper category and a decline of 3% for the global equity markets. Before we begin, a few words about Banque de Luxembourg Investments. BLI is the asset management arm of Banque de Luxembourg. We manage 13 billion euros through four main asset classes: equities, bonds, asset allocation strategies, and funds of funds. Our investment strategies are based on an active, conviction-based and long-term oriented approach that focuses on the generation of attractive risk-adjusted returns. Do not hesitate to ask your questions during the presentation using the chat system. We will answer them at the end of the presentation. A summary of this conference will be published in the coming days in English as well as in French. And now I give the floor to Guy Wagner.
Yes, thank you very much, Françoise, and good morning, everybody. So the presentation will basically be in three parts. So the first part is a little bit our views on the macroeconomic environment. Second part is more on the financial markets, but more on different points that seem or that are relevant in the context of the management of the flexible fund, and the third part is then on the current allocation of the flexible fund. So let's start with the macroeconomic environment. What we've seen, and this slide is basically the slide is simply an illustration of what has been happening. So you see there the GDP in the US, and with the expected evolution of the GDP, and you see that basically that it will last, or at least according to current assumptions, it will last some 10 quarters until we're back at the level that was predicted at the beginning of this year. So basically 10 quarters, that's 2.5 years. So you can see obviously that the economic damage has been quite massive. On the other hand, what we've always also seen is after this sharp drop in the second quarter, we had quite a big rebound in the third quarter. And I think what's very important to note is obviously this rebound, which is, at least for me, most unexpected, or at least the size of the rebound is obviously due to the unprecedented support measures that have been put in place. And this graph, for example, shows a little bit the support measures. What you see there is the disposable income of U.S. households. And you see that basically this disposable income has increased, which is kind of amazing when you know that the unemployment rate has risen, etc. But the reason obviously is the checks that the government is sending to people, and often the amounts on these checks are bigger than that what some of the people earned before. So this. In that sense, obviously the disposable income, household income, has held up very well, but one has to be aware that obviously it's a little bit artificial, because again it's due to these unprecedented support measures. A few months ago, the idea was that these support measures would gradually be reduced starting in autumn. We are now in autumn, and obviously there's no talk of reducing them. Quite the contrary, you hear in a lot of countries that governments are planning to even increase these support measures. So from that point of view, even though it's to a certain degree it's artificial, it obviously allows the economy to hold up quite well. But one has to be aware that behind the curtain, things look much less pretty. For example, you have a record number now of bankruptcies in the US. Obviously, these are often smaller companies, so much less talked about, but one has to be aware of that. So that's a little bit the cyclical idea. So strong fall in the second quarter, rebound in the third quarter, but obviously a rebound based on support measures. The more structural outlook, I wanted to come back on that a little bit. I've already shown these slides. The slide here shows that since the financial crisis, we had a much weaker growth in the US, so structurally weaker growth in the US, and basically it's the same when you look at the other G7 countries. You notice this trend towards a much weaker growth that we have experienced since the financial crisis. And I think that's important, and obviously there are reasons behind that, and I've in the following slides I'll show 7 reasons. Maybe there are more reasons, but I wanted to limit myself to these 7 reasons. And some of these reasons obviously have been even reinforced by the COVID crisis. First reason, obviously, is this debt levels. Here you see public debt as a percentage of GDP, which has exploded more or less everywhere. Private debt, obviously, is also very high. And there are simply a lot of academic studies who show that historically there has always been a strong link between too much debt and low growth. And obviously, again, that's one trend that clearly the COVID crisis has accelerated, given that public debt has increased since then. So that's a first trend. The second trend is the Eurozone, which is dysfunctional, which is not a surprise because a lot of, or some very serious economists, when we introduced the Euro, have said that the Eurozone simply doesn't fulfill the requirements for an optimal currency zone. You see there what these requirements are. You must have very high capital and labor mobility. You must have price and wage flexibility. You must have more or less similar business cycles among the regions or the countries which are part of the currency zone, and you have to need this, what they call always the fiscal union, tax transfers between the regions or the countries. The US is fulfilling most of these requirements, but obviously the Eurozone is not. And the consequence of that is what you see here. This is it's not industrial policy, it's industrial production since the introduction of the euro. And you see obviously the big divergence between red, which is Germany, green, which is Italy, and France somewhere in between. So from that point of view, obviously, given these problems, these structural problems within the Eurozone is incapable of becoming some kind of a lead or strong force in favor of much stronger growth. It's rather the contrary. Growth within the Eurozone has constantly disappointed. The third point then is more difficult to illustrate in a chart, so I put here this image. It's obviously the geopolitical tensions. In the 90s, after the fall of the Soviet Union, a lot was said about peace dividend, globalization. The US was the only superpower, and obviously with the rise of China, this has changed, and there are obviously these geopolitical tensions, but there are other tensions like the Brexit, and obviously this is not really conducive to companies investing massively. So another structural problem. Point 4 is obviously the growth in the world trade, a little bit the anti-globalization. Again, it's something that the COVID crisis might even have accelerated because there's a lot of talk about now of bringing back supply chains, and so it's a little bit against globalization. There's increasing tariffs, there's increasing tendency towards protectionism. Again, it's not something which is very helpful for economic growth. The fifth point is a little bit more unusual, much less talked about, is basically this idea that with the obsession of the authorities to avoid by any means any bigger downturns in the economy, it's basically also stifling economic dynamism. Schumpeter used to talk about creative destruction, so this idea that by necessity some companies need to disappear for others to prosper and for the economy to prosper, but basically this creative destruction has been halted by these policies of very low interest rates, etc. And I've tried to illustrate it here by this rising share of companies which are often called the zombie firms because the debt servicing costs of these companies are higher than their profits, so these companies basically should disappear, but they're not allowed to disappear. They're still there, and obviously that's weighing on the growth of other much more dynamic companies, and so weighing on economic dynamism in general. Point 6 is point which is interesting and will be important to follow. It's basically the idea that when you look at most of the industrialized nations, the growth and the GDP is basically to a very large degree based on private consumption. In the US, private consumption makes up nearly 70% of GDP. So obviously, it's this idea of consuming and, if possible, consuming ever more. And what's worrying in that sense is what you see here for Germany is this tendency now for rising savings rate. Obviously, this has been again accelerated by COVID. Maybe once we have maybe a solution to the COVID crisis, maybe savings will drop somewhat again. But it's a trend that we've seen for a few years now, and it's not limited to Germany. And obviously, higher savings rate normally don't point to higher consumption. So again, a point to keep in mind. And the last point is basically this rising inequality. Here you have the top 1% share in the US in terms of income and in terms of net wealth. Obviously, we all know that it's basically rich people who have benefited from the environment of the last years. And problem with that is that rich people tend to have higher savings rate. Again, it's a little bit linked to 0.6. And so basically these people might become richer, but they don't necessarily spend more. And those who don't become richer are usually those who spend a big part of their income. So from that point, again, this rising inequality not only leads to obviously more populism and this kind of anti-growth measures, but it also leads to this problem of, again, it reinforces this problem of economies being very dependent on consumption. So that's a little bit the idea. For me, usually the structural outlook or structural factors are more important than the cyclicals. And so again, one has to be aware of these problems. And you could even say, and that's this graph, that the system is broken to a certain degree. On the left side here, you see this vicious circle, which I already talked about now. You can start wherever you want. Weak economic growth, high levels of debt, low interest rates, low level of productive investments, an increasingly fragile banking sector, and which on the right you have these side effects of that. Because of low interest rates, you have obviously the rise in financial assets and property prices. On the other hand, because of low economic growth, there's no real wage growth, so there are these rising social inequalities, and all this leads to growing populism, etc. So it's not really a very nice outlook when you look at the economy, when you look at the growth aside. To finish, basically the macroeconomic outlook, I've talked a lot now about growth. Obviously, the other big important question is inflation, the price regime, and I think this question will be a very important question in the years to come. We've obviously had 40 years of declining inflation, and obviously the big question nowadays is not obviously for 2020, but longer term, will we now enter a regime of much higher prices, of rising inflation? One graph which seems to go in that direction is this one. It's the link between money supply and inflation, and you see that historically there is quite a correlation between the two, which is obviously makes a lot of sense. And you see the exploding money supply over the last months, and from that point of view, obviously the pure monetarists will say it will lead to inflation. Obviously, on the other hand, we also had this situation in 2008 where, despite of this exploding balance sheets of the central banks, we didn't really enter a massive inflationary area. So one has to be a little bit prudent when it comes to necessarily concluding that we'll enter a new inflationary regime, but one has to be aware of the risk. The reason why that didn't happen until now, and why it didn't happen after 2008 is basically this: it's the velocity of money which has only fallen. And without becoming too technical, there's always this equation from Irving Fisher which says that P are prices, T are transactions, so P times T is the GDP, equals M times V. M is the money supply and V is the velocity of money. And the idea in this is usually if you increase the M, so money supply, dramatically, V used to be sort of as being more or less constant. Then obviously if you have a strong increase in MV, you need a strong increase in PT. And given that transactions usually don't rise that quickly, then usually it leads to inflation. But what has surprised a lot of economists, obviously, is this dramatic fall in the velocity of money. And I think it's something that one has to follow, because it will be a very good indication to really notice that either things are changing, or maybe the disinflationary factors of digitalization, etc., will continue to lead to low inflation. So I think it's a very important question. Unfortunately, it's a question where it's impossible right now to be sure of what we'll have in 1, 2, or 3 years' time. But it's something that one has obviously as a portfolio manager to be very aware of, because obviously a high inflation or a much higher inflation regime leads to very different conclusions than a lower inflation regime. So a summary of all this, but I'll go over that very quickly because I've already said everything. We had a strong decline in second quarter, strong recovery in the third quarter. I think a lot of the good news, very good news, are now behind us. Obviously, one has to be aware of the importance of the support measures that have been put in place. And I think the main conclusion of what I'd said is, for me at least, the idea that we will then transition again to a strong organic growth in the private sector, for me, is at least very doubtful. On the inflation side, as I said, I think so basically it will come to this. Will the price regime of the future be determined by the real economy with digitalization, etc., that is not necessarily conducive to higher inflation, or will it be determined by the political economy? So basically this idea of disappearance of the border between monetary and fiscal policy, so increased public spending financed by money creation, that obviously would be inflationary. Again, for the moment, it's obviously this is not a question for 2020, and it's simply impossible now to have a definite answer on that. So that's a little bit our view on the outlook, on the macroeconomic outlook. So markets, what are the main, basically, factors that are important, as I said before, especially in the context of the management of the flexible. So first of all, obviously, we've had a confirmation, basically, and obviously the current crisis has even increased that. We have the confirmation of an environment of very low interest rates for a very long time. And the recent Powell speech confirmed that. Basically, it showed that the Federal Reserve has no intention of raising their interest rates before 2023 at the earliest. Some people talk even about 2025. So again, we have this confirmation of very low interest rates and central banks which basically have no credible plan to exit these very unusual monetary policies. Long rates, which are usually determined by the market and not by central banks, you see the declines there over the last basically 40 years, and we all know government bond yields are now very low, even negative in some areas. Here you have the 10-year Treasury yield for the U.S. It's in nominal terms, it's still slightly positive. In real terms, so in adjusted for inflation, it's negative. And basically what that simply means is that this asset class has become very unattractive. I often surprised when I still hear these arguments, equities are risky and government bonds are safe. One has to be aware that if you accept that the attractiveness of an asset class is determined by its risk-return profile, you must admit that the risk of government bonds and of bonds in general has only increased. Durations are much higher nowadays, and the return has basically disappeared. So again, especially for a balanced portfolio manager, you simply can't go back to this idea of 50-50 because the 50 fixed income doesn't often make a lot of sense. So by definition, then you are in this context where you have to look to equities as a motor for your performance. And I often say that nowadays, given the current situation with interest rates, I often say that basically what the global flexible is doing, it takes equities as a driver of performance, and it combines these equities with assets which are supposed to protect the portfolios in times where equities suffer. That's basically the general idea of the fund. So here you have the evolution of the equity market in US dollars since 2015, and basically the idea is simply to show that contrary to the economy where you see the damage and where it might last some 10 quarters before we're back at levels we've seen before, the equity market has done that very much more quickly, and it's already been back to the level of before the crisis. So that's interesting, and that leads some people to say there's a disconnection between fundamentals and the equity markets, because again, it's a little bit surprising when you look at the economic damage, that the market is already back near its all-time highs. Here also what we've seen is that trends that already existed before the COVID have only been accelerated by the crisis. One of these trends is the outperformance of the US compared to, for example, Europe, and obviously the other is the outperformance of technology and of quality stocks in general. So here you have one graph which a little bit shows that you have obviously, and we all know that it's basically, even for the US, it's basically 6 stocks which are really driving the market. And you see that if you exclude these 6 markets from these 6 stocks from the S&P 500, the S&P still outperforms, but obviously the outperformance becomes much less than when you include these 6 stocks. So that's obviously something that it's important to note, but also I think I often say that the outperformance of the US to a certain degree is logical, and if you because it's linked to the composition also of the index. Here you see that for the S&P 500, black are what we tend to often characterize as the value sectors, the very cyclical sectors, financials, energy, etc., and orange are the more growth and stable sectors. And you see that the composition has changed quite a bit over the recent years. So the part of these more cyclical things has only declined, and the part of the more stable things has increased. So in this environment, it's quite logical that the US outperforms. And for example, as an example, the technology makes up 27% of the S&P. It makes up less than 5% of the MSCI Europe. Vice versa, the financials make up 20% in Europe, 10% in the US, and even in the US, these financials are often growth companies like MasterCard or Visa rather than the typical banks. So again, it's a very logical thing, this outperformance of the US market, and I often say that people who tell me that now it's time for Europe to outperform, it basically means that these people are betting on an outperformance of value compared to growth, because that's basically what it comes to. The outperformance of the US compared to Europe is due to the fact that we've obviously been in an environment where growth has massively outperformed value. And you see that in this slide basically for the US. So blue you have value compared to the market, and on the other hand you have growth and quality, and obviously we all know that growth has massively outperformed, and it's basically the same in Europe. Again, it's the same idea. Growth outperforms value, and I would say it makes a lot of sense. I am aware that now and often get this question that value seems to be so cheap and growth seems to be so expensive. So isn't it time to switch from growth to value? Those who know our funds and our equity methodology know that we will never invest in banks or commodity producers, etc. So for us, the question is not very relevant. But I would also say that again, I think there are a lot of fundamental reasons for the underperformance of value. Most of the sectors that are usually put in the value category have some massive structural problems which have only been accelerated by COVID. So one has to be aware of these. And on the other hand, the more quality names, obviously given that they offer much higher visibility on their earnings, they are by definition the main beneficiaries of an environment of very low interest rates, because their future cash flows can be discounted at much lower interest rates, and obviously that leads to much higher current values. So there's a lot of logical things in that. It's not a bubble. It's simply something which is quite again logical when you consider the environment we are in. Maybe another point, and that's more something that everybody has to finally come up with his own conclusions. I sometimes what I try to do here is basically I showed the return of the S&P over the last decade. Obviously, it was a very nice decade for the S&P and for most equity markets because the market made over 13% a year. 2% coming from dividends, but then basically the idea of this was simply to show what can we expect for equities for the decade which has just opened. So when we're in 1930 and look back, what kind of equity return we can realistically expect, and it's an interesting exercise because it forces you to a little bit be more precise on your assumptions on the different components of equity returns. So these components obviously are earnings and multiples, and earnings you can divide into top line growth, sales, and margins. And then you have, and I tried to show most of these how these components have evolved over the last decade, and then obviously the interesting thing is for everybody is to say what are my assumptions going forward. For example, will margins continue to increase? Will buybacks still be such an important factor? Will multiples continue to increase, or will everything go into reverse, and then obviously we'll get very negative returns? And again, everybody will have his or her own views on that. Just maybe 3 slides to contribute to that discussion. Here you have profit margins in the US, which again over the last decade have increased quite a bit. So and they are now at near historical highs. So some people who are more positive will say they will continue to increase because of digitalization, robotization. Some people who are more negative will say no, we'll get higher tax rates, we'll get much less capital-friendly and much more labor-friendly policies, and there will be some kind of end to this shareholder-first capitalism. So basically, a lot to think about, and everybody will have his or her views, but it's an interesting, at least it forces you to be aware of what's going on, and especially when it comes to margins, obviously the issue of the US elections will be quite interesting. Will we have a massive shift to the left or not? Same for buybacks. Buybacks basically are the consequence, or have been the consequence, of low investments. You see here the divergence between profits and investments, and obviously that leaves a lot of cash that you can use to do share buybacks. Will that continue? It will be obviously depend on investment opportunities. The share buybacks might also be less well politically accepted, especially for sectors which needed the help of the state. So we'll have to see how that will evolve. And then obviously the big question is the question on multiples. Will multiples continue to increase? Will they fall again, etc.? Multiples, it's always a little bit difficult when you compare multiples to their historical average, because what is your starting point? If you look back 20 years and multiples don't look very expensive, when obviously you look back 70 years, they look quite expensive. What kind of multiples do you look at? Price book, price earnings, etc. Historically, the best relation or the best indicator has been what is often called the Shiller PE, or the cycle adjusted PE, so where you normalize earnings to a certain degree. And you see there that obviously the US is expensive. It has been more expensive in 99, but apart from 99, it has never been as expensive than today. So it looks expensive. The others look a little bit less expensive. We know the reasons. It has to do a lot with the composition of the indexes, etc. But I think one important point again to temper a little bit the pessimism of some people who say that multiples can only fall is that 2000 we clearly had a bubble, and it was linked to inflated expectations, etc. And so the bubble explains the high multiples. In 2020 we have low interest rates, so I don't sense a lot of exuberance when it comes to equities, whether it's amongst the bank's clientele or in general. We have higher multiples, but to a certain degree it's logical, because again you have lower interest rates, and usually lower interest rates lead to higher multiples, obviously as long as the economy holds up quite well. If obviously earnings were to fall, then everything would be different. But so these were more some of the general ideas that to illustrate a little bit things that we're discussing also a lot of internally. I think you can make a very, as I said before, you can make a very positive, optimistic scenario with increasing margins and increasing multiples. You can also have a very pessimistic scenario where you see margins falling and multiples falling. I suppose, and as often the truth will be somewhere in the middle. Maybe last point on the financial markets is some slides on gold, because it's important in the construction of the portfolio. Here you see the difference in performance of the S&P and gold since the financial crisis. Especially you see that gold has underperformed massively. I would say that gold nowadays is benefiting from a very strong structural story, and I would say that a lot or nearly all the reasons to be bullish on gold are in place. That's why some 12 months ago I said that, whereas before I said there's no clear trend in gold and we'll act a little bit in a contrarian way, we'll reduce our gold holdings when gold is strong, and we'll increase them again when gold is weak. Some 12 months ago I said no, we'll change now. We think that now there is a structural trend in gold and it's bullish, so we'll not decrease our gold holdings. And the reason I say that gold is benefiting from strong structural factors, a strong structural story, obviously you are aware, it's the massive increase in the money supply, it's trend towards much more expansive fiscal policies. We already have these very expansive monetary policies. It's the geopolitical situation. It's also the supply-demand situation of gold. So supply cannot increase a lot in the years to come because there hasn't been a lot of investments in the past. And there's basically, and that's I think the most important factor, it's the decrease in real interest rates. The graph there shows you the gold price in red, and it's the left-hand scale, and the correlation with the real interest rates in blue, right-hand scale, but inverse. So when the blue increases, it means that interest rates, real interest rates, are falling or are getting more and more negative. And I think we are in an environment where this will continue, and that would basically be a very interesting environment for gold. One always has to be aware that gold is volatile. There will be corrections, but again, I think the structural trend is upwards. When you believe that, then obviously gold companies are an attractive way of getting some leverage to a rising gold price. This is shown in this graph. Usually gold stocks amplify the movement of gold, and so basically that's something, it's the strategy we've adopted in the global flexible. So instead of having paper gold, we have invest in gold companies. When you do that, you have to be very, very selective. I think that when you look at gold companies, you have to be aware of the 3 Gs, being good management teams, good resources, and good jurisdictions. So that's something that's very important, but because this is a sector which in the past has destroyed more value than created value. And the last point, maybe on the valuation of these companies, you see here valuation, enterprise value to EBITDA for the US market, the black line, and you see again that the market is quite expensive. And on the other hand, the blue is for gold companies which don't look very expensive. Again, it's a sector which is volatile. You have to be very selective, and you have to be aware that sometimes, and this seems to be the case nowadays, sometimes gold stocks are more correlated to the stock market than to gold. So sometimes you have these phases, but again, at least I think that it doesn't make a lot of sense. If you believe that structurally gold price will continue to increase, it doesn't make a lot of sense to do some market timing to decrease, increase, because you risk of being out of these companies when you need them. So that's basically a little bit the general idea. Conclusion, maybe I've already shown this graph before. It's important to a certain degree for a structural asset allocation. The graph, the 4 quadrants, simply show you the 4 different macroeconomic environments that you can have. So you can have an environment of positive growth, low inflation, positive growth, high inflation, negative or very weak growth, high inflation, and negative growth, low inflation. And basically, according to the environment you're in, you have to weigh your asset classes differently, and in each environment there is usually one asset class which is a clear beneficiary. I would say that we've been in the environment in the lower right side, so this environment of positive growth and low inflation, which historically and logically is very positive to equities. Over the last 10 years, we've clearly been in this environment. We still think that we are in this environment, but we have nowadays much less conviction. So there might be, obviously, without these support measures, there's a risk of the economy falling back into recession, and obviously there's longer term, there's a risk of increasing inflation. So I would say that right now we're still in this positive environment for equities, but one has to be aware of the risks. And I think that the current environment, basically, it might sound a little bit simplistic, but again, if you look at it, it's basically what we have. First of all, you have a high level of debt, which basically precludes any monetary tightening by central banks and precludes basically any rise in interest rates. And then you have an environment basically where when you look at the supply demand of liquidity, you have an abundant supply of liquidity coming from the central banks, and you have a low demand for liquidity coming from the real economy. Companies don't invest that much. As I showed before, households tend to increase their savings rate. So there's a low demand for liquidity. So by definition, this liquidity has to go somewhere, and it goes into the financial sphere. And you can make a lot of very smart-sounding arguments about all the risks, etc., but that's basically the environment we're in. I think it's an environment where you have to prefer real assets, so shares, gold over monetary assets. I've here tried to listen again the arguments for and against the stock markets, but I don't want to necessarily go into them. I think that what's important, again, especially for investors in our funds, is the value growth story. Again, we typically are not in the what's often called the value sectors. But again, first of all, as I said before, I think it's this debate value growth is to a large extent the same debate, the same debates than between United States and the rest of the world. If you believe that the rest of the world is outperforming, you basically believe that value is coming back. And it's to a certain degree, you could say, it's essentially a question of, are you willing to pay a premium for stronger fundamentals, which you typically find in the growth area, or do you want a discount and are willing to accept a discount for weaker fundamentals, which are usually in the value category? For me, it took a long time before I finally understood that paying a premium for stronger fundamentals is by far the better response. You also have to be aware that structural growth is rare, so something which is rare becomes more expensive, and that's typically the case of the technology companies. And again, I think that these companies, these stable growth companies showing a lot of visibility when it comes to their earnings, are the main beneficiaries of the very low interest rate environment. And finally, when I said we're typically not in the value sector, I just want to make a distinction between the three areas that you typically find within value. You have the cyclicals, when this might be even in the consumer area or in the industrials. There, sometimes we're invested, obviously. Some of these companies look attractive, even though they're cyclical. Then you have commodities, the oil, etc., where we never invest, and banks where we never invest. So just to make this point clear. And the last thing I would say on financial markets, and I think it's difficult for us as portfolio managers, but I think it's important to avoid this tyranny of benchmarks. When you look at the S&P now, you have 5 of the 500 stocks, so 1%, which account for more than 20% of the index. Again, without talking about the merits of these companies, it's no longer basically the raison d'etre of an index. It's no longer giving a very diversified picture. So one has to be a little bit try to avoid, I think, this tyranny. I think, and that's a very important point, I think that in general, people have to revisit their definition of risk. We've all been raised in this business with this idea that equities are risky and government bonds are safe, and this made sense as long as your definition of risk is volatility. equity prices are more volatile than bond prices, and when that is your definition of risk, it's correct to say that equities are more risky. But if you, in this environment, I think your definition of risk should be a little bit different. Risk for me means losing definitely a part of your wealth, and a part which will then never come back. And I think when you look at it from that way, in a lot of cases, bonds are more risky than equities, especially when equities are selected very carefully. And linked to that is basically this idea that you have nowadays to accept a higher volatility as a price to pay for a return. If you don't want any volatility, then don't expect any return. I think when you accept again these ideas, some of these defensive sectors, even though they're equities, you could say that if the traditional role of bonds is to produce a recurring revenues via their interest, given that there is no longer any interest, you have some of the defensive sectors, obviously consumer staples or healthcare, which then, even though they're equities, might be a good idea to look at this kind of sectors as quasi bonds. And as I said before, gold, we're still bullish on gold, and we think that gold, it makes a lot of sense to have gold in your portfolio. So how did all this translate in the global flexible? Here, this is the asset allocation of end of September. 72% growth in equities. We still have some 20% which are hedged, so that gives you a net exposure to equities of around 53%. There currently are basically no longer any bonds, a very small proportion in bonds. As I said before, the reason of bonds and the reason we basically only had very long-dated U.S. government bonds is again this idea that the flexible is basically a combination of equities and things, asset classes, which are supposed to protect the portfolios in periods where equities decline. And obviously then government bonds made sense, but the 30-year U.S. Treasury yield fell below 1% in March, and we basically liquidated all our positions. We bought in August some, again, long-dated U.S. government bonds, but these are inflation-linked bonds. So still a very small percentage, but it's a percentage which might increase in the medium term. As I said before, and I often said that gold, we typically between 5 and 15%, but given that we are now structurally bullish on gold, we'll be usually near the 15% and not go back to 5%. And we still have some 11% in cash. In terms of regions, this is basically the split then between regions. Again, you have in beige, you have equities. Black are the equity hedges, only in the US and Europe, no hedges in Asia. And then you have bonds, which are only obviously in North America, because we only have US government bonds. And gold also are basically mostly Canadian companies. So again, it's in the North America part. As I said before, the sector allocation, very important. And again, it's something that you typically see even also for all our equity funds. Black is the index, beige is the fund. You see that we're not invested in energy, not invested in financials. And on the other hand, we tend to be overexposed in areas like industrials, consumer, whether it's cyclical or staples, healthcare and technology, even though nowadays technology it's a little bit lower. You have to find a good balance between the structural story, which is still very positive for some of these companies, and the valuations, which sometimes is a little bit extended. Top positions. Again, Roche is still the main position in the equity portfolio. Franco-Nevada is still the main position in the gold portfolio. Currency allocation, I've often said we don't look at ourselves as being experts on currencies. We don't have usually strong views on currencies. So the idea is basically just to if we hedged part of the US dollar exposure, and the main idea of this hedge is to increase the euro exposure. We have a fund which is expressed in euros. The performance is measured in euros, but we don't have that many euro investments. So to increase the euro proportion to at least 30%, we have to hedge something else, and we decided on the US dollar, given that the yen and the Swiss franc again are part of this idea of having equities, but then having assets which are supposed to protect the portfolio in periods which are more difficult for equities, and usually the Swiss franc and the yen are risk-off currencies which tend to do well when equities are declining. So that's the main reason we wanted to have a higher exposure to euro. It's not that we are particularly bullish or bearish on the dollar. The advantage obviously is nowadays the cost of hedging has declined because interest rates in the US have fallen back to zero. So that's obviously anti-dollar has been quite strong over the last year. So it's not such a big thing to hedge part of it now. This slide is basically the evolution of the asset allocation since the beginning of the year. We entered the year with a lot of cash, and during March we put some of that cash to use and increase the equity part. But then we, unfortunately, in hindsight, we hedged part of the equity exposure, and we still have part of that hedge in place. As I said before, bonds, we basically sold our bonds in after the US 30-year US Treasury fell below 1, and we only bought back a little bit, and gold is supposed to remain more or less close to its maximum of 15%. And then nowadays we still have 11% in cash. And then maybe this slide on the main contributors, purely the equity portfolio, so without the gold equities, you see basically it's just more for illustration. Obviously on the positive side you have some of the companies which are directly or indirectly linked to tech, Taiwan Semiconductor, Logitech, Accenture, Alibaba, Tencent. And on the negative side, you have something which sometimes you can call a little bit more value, the two holdings in Asia, Jardine and CK Asset, and then some of the more cyclical industrials, GC Deco, etc. So that's just to illustrate a little bit what has been happening and what has contributed since the beginning of the year. So I'll end my presentation there. The last, basically, a few slides on the performance compared to the Lipper Group. We also show for illustrative purposes the JP Morgan Bond Index and the MSCI World Index. But that's, again, you can look at that at your ease. I don't need to comment that. So, and with that, I'll end my presentation and I open up for questions.
Thank you very much, Guy. We have a few questions. The first one, does the prospect of higher inflation down the road mean you might adapt the style of your investments in the equity asset class? I think you already maybe touched the subject during your presentation, but if you can elaborate a bit more.
Yes, basically the idea is simply to say no, in the sense that those who know our equity methodology is basically in one sentence is buying quality companies at a reasonable price. And with these quality companies, that means companies which have a lasting competitive advantage, which allows them to differentiate from their competitors, enjoy higher margins, higher profitability, generate more free cash flow, be able to self-finance, and so don't have to take on a lot of debt, so have stronger balance sheets. And they are simply the sectors, a lot of these sectors which are typically placed into the value category and simply don't fulfill this category. They usually price takers, they are not price makers, and usually in the long term they don't create value for their shareholders. And so that's inherent in our methodology, and we won't change that. Again, I don't necessarily think that higher inflation would be negative for our kind of categories, because I would even say that it's the quality companies which have more pricing power. So in an area of higher inflation, they might be able to increase their prices, increase their dividends. And on the other hand, the typical value categories often have very high fixed costs. So in an area of higher inflation, they will suffer from higher costs without necessarily being able to increase their prices. So I don't necessarily think that from that point of view, even in an environment of higher inflation, the sectors that we don't invest in will do much better.
Thank you. Second one, is there a limit to central bank's powers? Could the bond vigilantes wake up one day?
Yeah, that's a very good and important question. I don't know, simply. I mean, obviously, right now you don't have the impression that there's a limit to central banks' powers. A lot of us thought that with interest rates at zero, basically they wouldn't have any more ammunition, but they've showed that they might find other ways to act and basically what we've seen with the rebound in equity prices since March is that markets still strongly believe in central banks. So we'll have to see how that will evolve, but as long as they are there, I think you could even make a case for equities as being too big to fail, because a lot of what the central banks have done over the last years was based on this idea, which for me is a little bit strange, but it's clearly the idea of creating a wealth effect, etc. So I think that they wouldn't simply sit there and look if equity prices were to fall massively. There can always be a correction, but I think that's right now it's not in there. They're not willing to let financial or risk prices fall too much. But I don't know how long this can go on, and if there will be a day sooner or later where markets and people in general lose faith in central banks. Bond vigilantes, yeah, the idea was typically to say if bond vigilantes, bond investors smell inflation, they will sell their bonds and ask for higher interest rates to be compensated, and that's usually how it goes. But again, are we still in this kind of, I would say, market economy? I doubt it. And when you look at what's been happening, and Japan is a good example, they were willing to anchor the 10-year bond yield at zero, and they intervened to maintain it there. And the Federal Reserve has often now talked about this and as being a possibility. So I don't think that necessarily bond vigilantes will still be allowed to drive up or to drive down bond prices and drive up bond yields.
Thank you. And another question. How are the equities in the portfolio hedged, and how do you define the percentage of the portfolio to be hedged?
Yes, the equities are hedged basically by selling futures. The futures are sold on or right now at least, on the S&P 500. The Stoxx 50, I would prefer the Stoxx 600, but the Stoxx 50 futures are much more liquid, and sometimes on the Swiss or UK market, because again the others are only on the Euro 50. So that's basically where we hedge. I said in the past that I don't necessarily, in 2012 and 2013 the performance suffered from this kind of situation where I had basically a big equity position and hedged it by selling futures. And what one has to be aware of, if I sell futures, obviously I'm short the sectors I'm not in, banks, etc. So I doesn't necessarily want to have this kind of situation. And I said that I've tried to learn from my mistakes from 12 and 13, and I've often said that since then I've only used futures to hedge against a very specific risk. It was before the Brexit, where immediately after the Brexit we bought back our hedges, and it was 1 year later before the French elections, where again afterwards we bought back. These were very clearly defined short-term risks. Obviously in March it was it's the same idea a little bit. It was this idea of in this kind of environment, which was really where you didn't have a lot of visibility, where everything could happen, to hedge part of the portfolio. Since then, I've reduced the hedges, but I'm still, given that the uptrend was so powerful and so quick, basically it didn't really give me the opportunity, or maybe I hesitated too long before buying back these futures. Now I prefer to maintain them at least until after the US elections. And then we'll have to see how this will continue. But again, the idea is not necessarily to keep these hedges for a very long time. And even in the future, the idea will still be to sometimes use them for very specific reasons. And that's, again, as I said before, this time I would have preferred to close them, but again, the upward was so quick, and now with, again, a rise in COVID cases with the US elections coming up, I prefer to be a little bit prudent. But I would say to a certain degree, and it's a little bit unusual, at least over the last weeks, the hedges when the US stock market was up, didn't penalize me too much because, as I said before, right now the gold stocks are behaving a little bit much more like equities, and so they usually benefited from rising equity prices. So to a certain degree, that compensated the hedging. But again, that's not the reason why I have gold companies in the portfolio. Let's be very clear about that.
Thank you very much, Guy. We do not have any additional questions, so I think we will be able to close the call now. Should you have any questions or want more details on some of the topics we just covered, do not hesitate to ask your sales representative. They will be happy to do the follow-up with us. Thank you all for participating. I just see new questions. We still have a few minutes, so we can try to answer to it. Guy, the question is, are the technique of shorting used in the portfolio? I think it will be quite quick.
Yes, the answer is very short. No, the answer is no. No, we don't short any equities. We're not allowed to anyway.
Okay, thank you. So, as I was saying, thank you for joining us to this conference call. Thank you very much, Guy, for your time and your availability.
Thank you very much for your interest.
As said before, we will send you in the coming days a summary of the call, both in French and English. And I wish you all a nice day and a nice end of the week. Be safe and bye-bye.
Okay, thank you very much.
Bye.
Bye-bye.